Investing in stocks means buying shares of ownership in a company, giving you a stake in its success and the potential to earn returns over time. When you invest in a stock, you become a shareholder, and the value of your investment can grow in two primary ways: through capital appreciation and dividends. Capital appreciation occurs when the price of a stock increases. For example, if you buy a share for $50 and its price rises to $70, you earn a $20 profit per share if you sell. This growth is driven by factors like the company's performance, revenue growth, industry trends, and overall market conditions. On the other hand, dividends are payments made by some companies to shareholders as a portion of their profits, providing a steady income stream in addition to potential price growth. Investing in stocks is a key way to build wealth over time, as historically, the stock market has provided average annual returns of around 7 to 10% after inflation. However, stock investing comes with risks. Prices can fluctuate due to market volatility, economic changes, or company-specific issues, so it's possible to lose money, especially in the short term. This is why it's important to invest with a long-term perspective and diversify your portfolio to spread risk. Getting started with stock investing is easier than ever. You can open a brokerage account with platforms like Robinhood, Fidelity, or TD Ameritrade. From there, you can buy individual stocks, such as shares in companies like Apple or Tesla, or invest in exchange-traded funds, ETFs, which bundle multiple stocks together for instant diversification. ETFs like the S&P 500 Index Fund track the performance of the largest companies in the U.S., offering a low-cost way to invest in the market as a whole. When choosing stocks, investors typically look at two main strategies: growth investing and value investing. Growth investors focus on companies with high potential for future earnings, such as tech startups. Value investors, on the other hand, look for established companies that appear undervalued compared to their fundamentals, aiming to buy low and sell high. For example, imagine you invest $1,000 in a growth stock that increases in value by 20% over a year. Your investment would grow to $1,200. Alternatively, if you invest in a dividend-paying stock that provides a 4% annual dividend, you would earn $40 in cash, plus any gains from the stock's price appreciation. The key to successful stock investing is to stay informed and avoid emotional decisions. The market can experience short-term ups and downs, but patience and consistency often pay off over time. Many investors use strategies like dollar-cost averaging, where they invest a fixed amount regularly, regardless of the market's performance. This helps reduce the impact of market volatility and ensures steady growth over the long term.